they tell you the dollar is too big to fail. That there's no alternative with enough depth, enough trust, enough plumbing to replace it. And yet, out of view, the behavior is changing. Not in headlines. Not in campaign speeches. In balance sheets, settlement instructions, and a slow drift of reserves that doesn't need permission to happen. If central banks were truly married to the dollar, they wouldn't be shopping around for backup plans. They wouldn't be building new payment rails that can route around it. They wouldn't be adding to gold while publicly calling it a non-yielding asset, like a hobby. So why do the numbers keep whispering a different story than the narrative? Maybe this isn't a revolt. Maybe it's a risk committee doing its job. But if enough committees reach the same conclusion at the same time, what looks like prudence starts to resemble a migration. And migrations don't announce themselves. They simply become obvious later, when the old map no longer matches the terrain. The phrase abandoning the dollar sounds dramatic. It sounds like a clean break, a flag torn down, a new one raised. That's not how institutions move. They inch. They hedge. They deny the direction until the new position is already built. The real question isn't whether the dollar disappears. The real question is what it means when the world's most careful actors stop treating any single currency as untouchable. This is the part most people miss. Reserve currency status is not a trophy on a shelf. It's a set of habits embedded into contracts, commodities, insurance models, and the quiet math of collateral. Habits can change without anyone declaring a regime change. They change when the cost of staying loyal exceeds the cost of being flexible. Start with the incentives that don't make the evening news. A central bank isn't trying to get rich. It's trying not to get trapped. It holds assets that must be liquid in a crisis, acceptable in global trade, and safe from political pressure. That last part is awkward to say out loud, because it sounds like an accusation. But it's the unspoken center of the job. For decades, the dollar solved a brutal coordination problem. Everyone used it because everyone used it. Oil was priced in it. Shipping was billed in it. Debt was issued in it. And the financial system built deep pools of dollar liquidity that other currencies couldn't match. In a panic, you didn't ask what you preferred. You asked what you could actually get. Then the world started running stress tests it didn't know it was signing up for. One shock after another. Supply chains that snapped. Sanctions that didn't just punish behavior but rewired access to reserves. Interest rates that surged after years of near-zero assumptions. When the baseline keeps shifting, risk-free becomes a label you revisit, not a permanent truth. Central banks watched something else, too. The dollar's strength became a weapon even when nobody meant it as one. When the dollar rises, it tightens financial conditions everywhere that borrows in dollars. It doesn't matter if a country ran its budget responsibly. The exchange rate still hits. The debt service still bites. And suddenly domestic stability depends on decisions made in another capital, for reasons that have nothing to do with you. So what do you do when your stability is correlated with someone else's politics? You don't shout. You don't threaten. You diversify. You build options. You create a world where you can still trade if the room goes dark. The public tends to imagine reserve management as a simple portfolio choice. Dollars, euros, maybe a little yen, maybe a little gold. But the real constraint is operational. Can you settle transactions at scale? Can you access liquidity at 3 a.m. when markets are frozen? Can you pledge assets as collateral without legal ambiguity? Can you move value without needing a chain of correspondent banks that can be leaned on, pressured, or turned off? This is where the story gets uncomfortable, because it's not about morality. It's about controllability. The dollar system is powerful because it is centralized around a network of institutions that cooperate, share standards, and enforce rules. That cooperation is what makes it reliable. It's also what makes it vulnerable to being used as leverage. From the perspective of a central bank outside the inner circle, the question becomes blunt. Is the dollar system a public utility, or is it an instrument of statecraft with utility as a byproduct? Even if you love the stability it provides, can you trust that access is guaranteed in every political climate? Or do you treat it like any other dependency and reduce exposure? This is the backdrop for the so-called 2026 gold rush. Not people lining up at pawn shops. Not a sudden mania for jewelry. A steady, institutional preference for an asset that doesn't require anyone's permission to hold. Gold doesn't default. It doesn't get sanctioned in the same way a bank account can. It doesn't depend on a foreign legislature, a court system you can't vote in, or a payment network you don't control. Gold is annoying in modern finance. It sits there. It costs money to store. It doesn't pay interest. That's the surface-level critique. The deeper reason it's attractive is simpler. It can't be printed, and it can't be frozen with a keystroke in the same way a bank balance can. In a world where trust is a variable, gold is an escape hatch. But gold alone doesn't run a trading economy. You can't pay for a container ship with a bar, at least not at scale. So the move, if it's happening, isn't gold replaces the dollar. It's gold plus alternatives reduces dollar dependence. It's a portfolio and plumbing shift, not a sudden conversion experience. Look at the environments central banks are navigating. Domestic politics are more volatile. Alliances are more conditional. Debt levels are higher across major economies. The world is more multipolar, not just in military terms, but in technology and manufacturing capacity. When power is distributed, the incentive to accept a single choke point decreases. At the same time, the dollar has its own internal logic that makes others nervous. The United States can run deficits and still borrow cheaply because global demand for safe dollar assets remains enormous. That privilege is real. But it also means the rest of the world is, in effect, financing an American policy mix it doesn't control. When rates rise, the burden spreads outward. When rates fall, capital can flood in and out of emerging markets like a tide that doesn't care who gets dragged. Central banks remember the past, but not in the sentimental way. They remember how fast confidence can evaporate. They remember that liquidity is not evenly distributed. They remember that in a crisis, the definition of safe narrows to what can be sold instantly. And they remember who controls the valves. So they start doing quiet things. They add more counterparties. They shift some trade settlement into non-dollar currencies where possible. They enter swap lines where they can. They develop regional systems that reduce the need to pass everything through New York or London. They test digital settlement tools, not as a futuristic gimmick, but as redundancy. This is where the story becomes easy to misread. Every one of these moves can be defended as ordinary modernization. Nothing to see here. But taken together, they point to a change in how risk is perceived. The dollar is no longer treated as the default answer to every question. It's treated as one answer among several, still dominant, still deep, but no longer sacred. And that change matters even if it's incremental. Reserve status is a confidence game built on expectations. If the expectation shifts from the dollar is the only game to the dollar is the main game but we can play others, the demand for dollars becomes more elastic. That doesn't mean collapse. It means sensitivity. Now add a specific pressure that looks technical but behaves like politics. Sanctions architecture has matured. Financial surveillance has expanded. Compliance rules have thickened. Even countries that broadly align with the United States notice the trend. If tools exist, they can be used. If precedent exists, it can be extended. Risk managers don't need to believe they will be targeted. They only need to believe it's possible under certain circumstances. So central banks ask a question that sounds disloyal but is, from their view, responsible. What happens if the geopolitical weather changes faster than our reserve portfolio can? What happens if access to certain assets becomes conditional? What happens if a conflict, a trade rupture, or a diplomatic shift turns our reserves from a shield into a liability? That's the mindset where gold starts to look less like nostalgia and more like insurance. Not because it's perfect. Because it is outside the system. In finance, being outside the system is usually a disadvantage. In geopolitics, it can be an advantage. Here's the pivot most narratives miss. The biggest driver of de-dollarization is not ideology. It's operational friction. The world is building parallel pathways because relying on one pathway has become expensive in ways that don't show up as a line item. The cost is in uncertainty, in legal complexity, in the risk of being caught in someone else's dispute. And the people making these decisions don't need to hate the dollar. They can respect it and still reduce reliance. A bank can admire the strength of a bridge and still build a second route out of town. Especially if traffic keeps increasing and the bridge owner keeps reminding everyone they can close lanes when they want. There's also a quieter reason central banks might be tilting away from the dollar. The composition of global trade has shifted. Some regions trade more within their own neighborhoods than before. If you can invoice and settle in a regional currency, you reduce currency mismatch risk. You reduce the need for dollar liquidity. You reduce the exposure to dollar funding markets that can seize in a crisis. But that creates its own problem. Regional currencies lack the deep, universally trusted bond markets that make the dollar unique. You can settle trade in another currency, sure. But where do you park reserves in size, safely, with real liquidity, and a legal framework that doesn't surprise you? That's the vacuum gold partially fills, even if imperfectly. So the 2026 gold rush isn't a bet on shiny metal outperforming everything. It's a signal that the world's institutions are thinking in contingencies. Gold is not a growth asset. It's a political asset. It's the asset you hold when you want to be less entangled with other people's rules. Now consider what it means for the dollar if this behavior spreads. The dollar's strength comes from network effects and deep markets, yes. But it also comes from relentless global demand for dollar-denominated safe assets. If that demand softens at the margin, the United States may find it slightly more expensive to finance deficits. Not immediately. Not catastrophically. But enough to matter over time. That's where the story becomes about choices. If financing costs rise, policymakers face trade-offs they've been able to postpone. Higher rates mean more interest expense. Lower rates risk inflation and currency weakness. Either choice has political consequences. The dollar's privilege is not just a bragging right. It's room to maneuver. Meanwhile, other currencies face a different constraint. To become a true alternative, you need open capital markets, reliable rule of law, and a willingness to run persistent deficits that supply the world with your assets. That last part is the trap. The world demands safe assets, but supplying them often requires issuing more debt. So any currency that wants to replace the dollar must accept some of the same burdens the United States carries. This is why abandoning the dollar is probably the wrong mental model. What's emerging looks more like fragmentation. A world where the dollar remains dominant, but not exclusive. A world where trade is settled in multiple currencies depending on the corridor. A world where reserves are spread across a broader set of assets, including gold, to reduce political risk. Fragmentation sounds benign until you think about crisis moments. A single dominant system is efficient in calm weather. But it also concentrates risk. Multiple systems can be resilient. They can also be chaotic. When liquidity is divided, a shock can create mismatches. In the old model, everyone ran toward the same currency. In a fragmented model, everyone runs toward different doors, and some doors are narrower than they look. This is the twist. Central banks may be seeking safety by diversifying away from the dollar, but in doing so they may be reducing the very coordination that makes global finance stable. If too many actors treat the dollar as conditional, the system becomes more sensitive to rumor, to policy shifts, to sudden repricing of trust. That sensitivity can create volatility that then pushes more actors to diversify. A feedback loop begins, not out of malice, but out of self-preservation. And there's another, even more subtle pivot. The dollar system is not just a currency. It's a governance system. It sets standards for compliance, transparency, and the flow of capital. As alternatives grow, standards diverge. Different blocks build different rules. That can weaken the ability to respond collectively to crises, because the shared language of finance becomes less shared. So what are we really watching in 2026? Not a dramatic dethroning. A slow negotiation over dependence. A recalibration of what safe means when safety includes political neutrality and operational control. A collective attempt to avoid being cornered, even if avoiding corners makes the room messier for everyone. If you want a single image, don't picture a stampede out of the dollar. Picture a room full of cautious people quietly moving their chairs closer to the exits. No one is leaving yet. But everyone wants the option. The most telling part is the silence. If a central bank openly declares it is moving away from the dollar, it risks retaliation, market panic, or self-inflicted losses as its own remaining dollar assets devalue. So it doesn't declare. It reallocates slowly. It uses technical language. It calls it risk management. It frames it as routine. And the dollar, for its part, doesn't need to lose its top spot to feel the impact. It only needs to become slightly less essential. Slightly less demanded. Slightly more questioned. Empires don't fall because someone wins a debate. They lose frictionlessly at first, then all at once later, when the assumptions that held them up are no longer shared. The open question isn't whether the dollar survives. It almost certainly does, because it's embedded everywhere and backed by a vast financial ecosystem. The open question is whether the world is entering a period where no currency gets to be the unquestioned center. And if that's true, what replaces the stability that came from a single default? Because stability isn't free. It's purchased with dependence. The moment too many actors decide dependence is too costly, they will pay for a different kind of stability, one built from redundancy and hedges. That stability can work. It can also be brittle in new ways, because coordination becomes harder and trust becomes more transactional. So when you hear gold rush, don't think of greed. Think of fear dressed as prudence. Think of institutions that have watched the rules change mid-game and decided they need a game that can't be paused by someone else. Think of power adapting to power, without speeches, without drama, and without asking your permission. And then ask the question that doesn't have an easy answer. If central banks are quietly preparing for a world where the dollar is optional, what does that imply about the kind of shocks they believe are plausible? What do they see coming that they can't say out loud? And if the guardians of monetary stability are building escape routes, should anyone assume the exits won't be needed?